Markets are inherently volatile, but what we are witnessing right now is not just volatility, it is a structural collapse of the paper narrative. Surprised gold just had its worst week in 15 years. Let that sink in. The worst week in 15 years. Since hitting the record high of nearly $5,600 at the end of January, gold has lost 25% of its value in less than 60 days. Silver, which was trading at $117 just weeks ago, has nearly halved. Size. At Market Crux, we don't follow the hype, we follow the math. And the math is telling us that the safe haven narrative has been temporarily hijacked by a liquidity crisis. If you are holding precious metals thinking they will protect you in a vacuum, you need to hear this analysis. This is the most critical update we have ever released. Before we dive into the data, a mandatory warning: I do not sell courses, I do not sell signals, I do not have a paid mentorship. If anyone uses the Market Crux name to ask for your money, block them. They are scammers. I am only on YouTube and X at Financial Crux. I share this clinical analysis so you can make informed decisions. If you value truth over noise, drop Market Crux in the comments and tell me where you are watching from. Our community is global, and in times of crisis, intelligence is our only weapon. As of 10:30 London time this morning, spot gold is sitting at $4,262. It is down 5% today alone. Silver is at $63.76, a year-to-date low. Platinum and palladium are in a synchronized freefall. The selling is not slowing, it is accelerating. To understand why the ultimate hedge is failing, we have to look at the bond market. US 2-year yields have surged to levels that are mathematically suffocating non-yielding assets. The inverse relationship is playing out in textbook fashion. When yields spike, the opportunity cost of holding gold and silver becomes too high for institutional algorithms. But there is a deeper, more sinister shift. Gold is no longer trading like a safe haven. It is trading like a risk asset. The correlation matrix over the past week shows gold moving in lockstep with US stock futures. When stocks sell off, gold sells off. When volatility picks up, gold is not catching a bid. This is a massive regime change. If you are positioned in metals thinking they will protect you in a stock market crash, understand that right now, they are falling with the burning building, not acting as the fire escape. The driver of this yield spike is the escalating war in the Middle East. Operation Epic Fury has reached a boiling point. President Trump has issued an ultimatum to Iran: reopen the Strait of Hormuz within 48 hours or face the obliteration of your power plants. Iran's supreme leader has responded with a direct warning, promising a powerful blow to any country that attacks. The Strait of Hormuz handles 20% of the world's oil. Shipping has already halted due to a lack of war risk insurance. Brent crude has touched $100 a barrel. This is not just a disruption, it is supply destruction. When energy prices spike, inflation expectations jump. When inflation expectations jump, yields move higher across the curve. This yield pressure is what is crushing precious metals. While retail investors are panicking, the big money in the East is making a massive move. Bian Shiming, the Chinese billionaire who made $3 billion riding the gold rally, has flipped. He now holds the largest net short position in silver on the Shanghai Futures Exchange, 450 tons. He is betting that the speculative froth in silver needs to be cleared out. He shorted into the highs of January 30th and is already up hundreds of millions of dollars. But he is playing a dangerous game. On one side, you have his massive paper short position. On the other side, you have the reality of the vaults. The COMEX and London silver vaults are being drained at a historic pace. Registered inventory has collapsed from 150 million ounces to just 86 million in 63 days. China's own physical reserves are depleting. You cannot create physical silver out of thin air to cover a paper short. This creates a binary setup. Either the paper price manipulation succeeds in forcing physical holders to sell, or the physical scarcity triggers the greatest short squeeze in human history. One of the most bullish pillars for gold over the last 2 years was central bank buying. But the data suggests a pivot. As the war escalates, central banks in Gulf states are reportedly tapping into their gold reserves to preserve capital and defend their currencies. If the world's biggest buyers have become sellers to fund a war effort, it puts a structural cap on the price of gold that no retail stacker can overcome. This is institutional-level liquidation. The technical picture confirms the fundamental carnage. Gold broke its 50-day moving average and its long-term uptrend line. The path of least resistance is now down. We are looking at a test of $4,100 and potentially the 200-day moving average if the liquidation continues. Silver has flushed through $77 and is now sitting at a critical confluence zone between $63 and $64. This zone includes the August uptrend line and the February lows. If this level fails, silver could see $50 handles, a catastrophic drop from the $117 peak. However, there is a squeeze signal. Both metals are trading well below their lower Bollinger Bands. This indicates an extreme oversold condition. In these environments, the risk of a violent multi-hundred-dollar snapback rally is high. If diplomacy prevails in the next 48 hours and the Iran ultimatum passes without military action, the energy risk premium will collapse, yields will drop, and metals will see a historic V-shaped recovery. Despite the price crash, the macro fundamentals have not changed. U.S. GDP growth is at a sluggish 0.7%, while core inflation is at 3.1%. This is stagflation. The Federal Reserve is trapped. They cannot cut rates to save the economy without exploding inflation. The U.S. government is paying over $1 trillion a year in interest. Higher yields make the U.S. debt trajectory unsustainable. At some point, the Fed or the Treasury will have to intervene to cap yields. When that yield curve control happens, paper money dies, and hard assets catch a bid that will never be returned. The question is not if, it is when. Just last week, physical dealers were unable to source silver. Mints were shutting down sales. Physical premiums were at record highs. You cannot have physical scarcity one week and then claim the bull market is over the next. Paper selling represents leveraged speculators being forced out by margin calls. Physical demand represents real-world entities protecting their wealth. Historically, physical reality always wins, but the paper pain can last longer than most can stay solvent. You must decide which game you are playing. Are you a trader watching the hourly chart or an investor with a 5-year thesis? Watch the Iran Ultimatum. If military action begins in the next 48 hours, expect another leg down as yields surge. If diplomacy holds, prepare for a violent bounce. Monitor the $63 support in silver. This is the line in the sand. If it holds, the bull market lives. If it breaks, we enter a structural bear market. Track the Shanghai premium. If Chinese buyers continue to pay a premium for physical silver while the New York paper price falls, the decoupling is happening. 75% of you watching right now are not subscribed. If you want the raw truth that the mainstream media is too afraid to tell you, hit subscribe. Join our WhatsApp community in the description to stay connected during the great liquidation. Do not make emotional decisions. The next 48 hours will define the next decade of your financial life. Invest with logic, not noise. Market Crux, signing off.